Hello and welcome to Intuitive Investing. Today we're going to be having a look over my current portfolio, which was started on the 31st of March. Have a look at what I've already invested in and what I'm going to be adding to my holdings in the coming week when the market opens again tomorrow. So we'll begin with Aviva. Now, Aviva is a stock that, to me, all indications are that it's pretty undervalued. If we look at the graph from a year, the low point that we really see is about £3.50. And we go back for the 5-year graph and we can see that again, it doesn't tend to drop beyond sort of, even the £4 range by and large, although we'll say £3.50 to be safe. Now, this is a company that is got good cash flow, it's been increasing revenue and dividend for the last few years. And its fundamentals suggest that it really is strong enough to weather the coronavirus storm. Now, as I'm writing this on the Monday, Easter Monday, the dividend return is 11.36%. Now, they pay 30 pence. Well, they paid 30 pence last year, though I imagine that will continue to increase or remain the same. Trading for £2.64. You can't really go wrong with that. Even if they were to slightly decrease their dividends and we take into account no capital gains from the actual increase in price of the share, it's still a very good position to be in. And with revenue last year of 31 billion and their profit being 3.9 billion, Aviva does seem like a safe bet. Next week, the following week coming, I'll probably be increasing my Aviva position quite a bit. I have a rough plan on a sort of Excel document or an app that's like Excel, and I'll show you that at the end. Although primarily I think I'll be increasing my holdings in Aviva in the following week. The S&P 500, that doesn't really need much more explanation. That's just an index fund, an ETF. It tracks the 500 biggest companies in the US, although that, of course, I will be increasing as well, just not so much at the moment. I want to focus on some dividend stocks, get some decent ones in the UK, and then when fractional shares come to Freetrade, which I'd imagine only a week or two away, I'll then start investing more into a more diversified growth portfolio as well as the ETFs. So then the next one we'll go to is Lloyds. And Lloyds, again, they have a revenue of 42 billion, a profit of 4.3 billion. To be trading at their current price of 33 pence, I would again say they're very undervalued. I would say a fair price to get Lloyds at, a decent value price that you have a safe investment. It'd be somewhere in the region of 50 pence. And if you look at the last year, that really is, 49 pence it drops to at one point. But if we look at the 5-year chart here, again, you're not really getting below 50 pence. And this is a company that didn't fully recover from the financial crisis of 2008. So I would say this is a safe long-term bet, and with their current dividend yield of 9.72%, I think their dividend is something like 3 pence, 3 pence 3.2 pence, sorry. That's not really not a bad price. I actually wish I got in a little bit earlier here. The bottom, they really did hit 28 pence. And Lloyds, again, very, very strong company, easily weather the storm, maybe even increase dividends as time goes on, as they're investing quite heavily in technology, trying to reduce their workforce, trying to increase profits. So, Lloyds, I would say, it's definitely a safe dividend bet for a stock. I'll go through my average price as well. The average price for me so far is 31 pence. So, there's a slight gain here. I'd really like to increase my position substantially more, since, it's only going to go up in price and there's a short window. So, the next one we'll go for the ones that Microsoft, I'm likely to sell if it can get back up to sort of break-even point. I bought in quite high then thinking I needed to sort of buy some techs, but with fractional shares just around the corner, I really don't need to. So hopefully I can break even on that and then use that to pump some more funds into my dividend portfolio. So we're going to have a look at BP. Now, this is going to feature quite heavily in next week's buys for me. So, it's trading at £3.31 at the moment, and it has been declining in sort of the past year, although a lot of that can be attributed to the uncertainty of the oil wars and just a general downturn in a couple of different sort of aspects that's all hit at once. Although, honestly, I would say a fair price for BP is somewhere around the £5 mark. If you want to be safe, you would go for £4.50. But this is a company, a massive company, one of the biggest in the world easily, and certainly one of the biggest oil ones, with a revenue of 278 billion. last year with a profit of 8.1 billion. And I mean, even though they are being quite negatively affected by all this OPEC and all the sort of uncertainty regarding oil at the moment, I mean, they can produce their oil for, I mean, it's quite cheap considering the circumstances. I think it's somewhere in the region of $20 or so, if I'm correct. I haven't got this anywhere, but so I really would say they could weather the storm as well. And for £3.31, you can't really go wrong, since the dividend, I can't remember the exact dividend, but the current dividend yield for right now's price is 9.82%. Now, I mean, this is a big company, it's got stable dividends. I really would say, despite the uncertainty with oil, to be invested in this one. So that's going to feature quite heavily in my portfolio next week too. We'll jump over to Shell. Now, I mean, Shell, essentially the same BP, very big company, even bigger in fact, revenue of 345 billion, profit of 25.4 billion, and I mean, for the share price of £14.80, when their dividend is about £1.50, I mean, the current dividend yield is 10.13%, so this is another one where, I mean, they're massive companies. They're almost to the point where they're too big to fail. They've shown they have the capability to take out cheap capital and then pay those dividends. So, I mean, again, this would be a good time to be getting into oil, despite the uncertainty. I mean, maybe ease into the position, try and get your dollar cost average down quite low and quite minimise any massive spike, because there could be more uncertainty ahead. But I would definitely say they're both decent stocks to go for. Now, we're going to have a look at legal in general. This is one where I don't have a position in yet either. This one, I mean, the dividend yield is 7.86%. So, I mean, it's substantially lower than all the other ones. Although this is a company where it does have the growth potential. I mean, it has the projections and they have been increasing their dividends. So, despite it being 7.86% at the moment, I mean, I can see that going up in the next couple of years with their increasing dividends. And they have said they're going to pay this year's dividend despite the UK government advising for banks, etc., to cancel their dividends, which is good, which is showing that they do have the capital, they do have the liquid to sort of get them through tough times. I mean, they have a revenue of 15 billion last year, a profit of 2.1 billion, and to be trading at £2.13, I would still say this one is worth a buy. I mean, obviously it hasn't dropped as substantially as the other stocks, and I mean, the growth potential is maybe not quite as high, but the long-term growth, as well as a decent stable dividend, it's worth it. So I mean, I'll also be investing into this next week, although to a lesser degree than my other stocks. So I'll take you over to my little spreadsheet that I made for next week, and this is how my fund allocation is likely going to look. I mean, there's going to be spikes in prices. I might see a good deal here, a good deal there. So of course, it's not going to be chalk and cheese. Well, no, it's not going to be absolute stuck to this buy. Although it is a good outline. So I mean, primarily Aviva, Lloyds as well, they're both very stable. I would say they're good long-term investments. You can see on the right-hand side that what my total allocation will be for the portfolio. So I mean, not as diversified as I'd like. These dividend stocks are certainly a good deal right now, so I'll get them all while I can. Although, yeah, I definitely will be going into more growth stocks in the coming weeks, especially with the fractional shares being released for Freetrade, which I would recommend anybody downloading if they haven't yet got a portfolio or have only just started looking into this during the crash, as myself has. So yeah, I think that's about it, to be honest. I mean, we'll have a quick look at Freetrade again. I'll likely be making regular videos, just tracking how my portfolio is doing, what stocks I think would be a good buy. I mean, it's not going to be limited to only UK stocks, that is for the time being, as obviously there's no fractional shares, and Microsoft, that's £130 gone for one share, so it's not really feasible in my position to be buying a lot of US stocks until those fractional shares are released, although there certainly will be a wide variety of them, even in other markets as well, as time goes on. So I'll keep you all updated, and yeah, see you next time.